Hello, and welcome to today's Explainer. We are looking at a market environment right now that is, well, it's highly volatile. It's aggressively repricing risk, and we're seeing it react to this massive confluence of global and domestic shocks. If you want to understand exactly where institutional capital is flowing and what's driving the volatility as we step into June 2026, you are absolutely in the right place. We're going to stick strictly to the data, break down the latest market action, and map out the crucial triggers for the week ahead. So let's get right to the numbers.
23,547.75. That is exactly where the Nifty 50 closed after a really sharp, punishing drop of 359 points. I mean, that's a 1.5% decline in just a single session. We saw widespread, broad-based selling right across the indexed heavyweights, and honestly, that just kept the benchmark firmly pinned in negative territory from the opening bell right through to the close.
And the pain? It was actually even more pronounced over on the BSC Sensex, which plunged by a massive 1,092 points. This aggressive sell-off literally wiped out recent gains and completely shifted the near-term technical sentiment. Financials, power, automobiles, consumer stocks, you name it, they were all dragged down heavily.
Now, here is the exact reason why. On May 29th, we witnessed a staggering foreign institutional investor sell-off of over 21,105 crore rupees. That is the single largest daily outflow we've seen for the entire month of May. When institutional capital of this magnitude heads for the exit all at once, the domestic safety net just gets totally overwhelmed, and that's exactly what drove this intense pressure on the indices.
Okay, let's dive into this. To make sense of all this action, here are our top stories today. We're going to look at the market sell-off and the MSCI rebalancing, the Q4 battle between revenue and margins, the impact of rising treasury yields, the global currency risk factor, and finally, the key triggers for your watch list next week.
Section 1. Market sell-off and the MSCI rebalancing.
So, the late session volatility we saw was heavily structural. It was driven by the May 2026 MSCI rebalancing. Now, this is an event forcibly moving over $1.6 billion in passive institutional flows. So, of course, we saw some clear winners and losers. On the inclusion side, you've got Federal Bank, MCX, Nalco, and Indian Bank entering the MSCI Global Standard Index. Federal Bank alone is expected to see passive inflows of around $491 million. Then, on the exclusion side, RVNL, Hyundai Motor India, Kalyan Jewelers, and Jubilant FoodWorks are out. Now, it is absolutely vital to remember that these are just mechanical index events, right? A stock like Hyundai isn't being excluded because its underlying business is suddenly failing. It's simply a matter of revised index criteria around things like free float and liquidity thresholds, which trigger mandatory passive selling.
But beneath those headline drops, we saw a massive sector divergence. The IT sector actually acted as a major shock absorber for the Nifty, rallying by 2.5% to 3%. This was really sparked by Wipro's massive overnight ADR surge following a new agentic AI deal with ServiceNow. Conversely, PSU banks, power, and metal stocks were just hammered. Why? Well, the market got heavily spooked by the IMD's forecast of a below-normal monsoon. And that immediately threatens power demand assumptions and industrial production expectations.
Moving on to Section 2, Q4 earnings, revenue versus margins.
Now, what's really interesting here is when we evaluate corporate India's performance in the final quarter of FY26, it reveals a fascinating story of friction. Look, top-line revenue is absolutely booming. Demand momentum holds really strong. Maruti Suzuki hit record quarterly sales of over 6.7 lakh units, and Mahindra posted record revenues of nearly 55,000 crore rupees. But the ability to convert that massive revenue into bottom-line profit is being severely compressed. Companies are getting squeezed from all sides by input cost inflation, elevated crude oil prices from geopolitical disruptions, and of course, a weakening currency. It's a classic high-revenue, low-margin environment right now.
But despite this margin pressure, corporate balance sheets remain incredibly resilient, and companies are aggressively deploying their cash. Listed companies reported a massive 10.5 trillion rupees in capital expenditure for FY26. That's a 15% year-over-year jump. Furthermore, reflecting their really strong cash generation, over 22 companies have announced share buybacks worth more than 25,000 crore rupees. Wipro is leading the charge here with a huge 15,000 crore rupee buyback at a premium price of 250 rupees per share. So while profits are squeezed, the cash reserves are definitely there.
All right, let's zoom out to Section 3, rising treasury yields impact.
A lot of the pressure on emerging markets right now is actually being dictated by the U.S. fixed income market. We are currently sitting at 2026 highs for U.S. Treasury yields. The 2-year is at 4.12%, the 10-year is at 4.67%, and the 30-year has breached 5.18%. Remember at the start of the year when the market was aggressively pricing in multiple rate cuts from the Federal Reserve? Yeah, well, those expectations have completely vanished. The market is repriced entirely, acknowledging that robust U.S. economic data means higher rates for much longer.
The crucial point here is how this changes the shape of the yield curve. We are seeing a distinct yield curve flattening. This happens because short-dated yields, which, are highly sensitive to immediate central bank policy, have actually risen faster than longer-term rates. Now, for fixed income investors, this isn't necessarily a bad thing. In fact, it presents a highly lucrative opportunity to step in and lock in these higher all-in yields right now across various fixed income sectors.
Pivoting now to Section 4, the global currency risk factor.
You really cannot understand the current stress on domestic portfolios without understanding the geopolitical impacts on the currency. The core vulnerability here is energy. India imports a massive 88% of its crude oil requirement. And this brilliantly illustrates why when geopolitical tensions, like the ongoing US-Iran conflict, cause Brent crude prices to spike, India's import bill inflates instantly. This creates a massive structural demand for US dollars to pay for that expensive oil. It's simple math. Higher oil prices directly drain dollars from the domestic economy.
And the mechanical result of that dynamic is this exact number, 96.97. That is the all-time low the Indian rupee just printed against the US dollar. It is a direct, unavoidable reflection of 3 compounding pressures: the inflated oil import bill, massive capital outflows from foreign investors, and a long-term inflation differential between India and the US.
Which brings us to a critical portfolio strategy point. Over the last 12 months, the rupee has depreciated by 12%. Simultaneously, FPIs have pulled a staggering 2.2 lakh crore rupees from Indian equities in 2026 alone. If you only hold a domestic equity portfolio, you're absorbing both the market sell-off and the currency erosion at the exact same time. This is exactly why retail investors are increasingly looking at global diversification. Holding dollar-denominated assets provides a built-in hedge, offering real protection against this specific persistent currency depreciation.
Finally, Section 5, key triggers for next week.
Because the data never stops, right? And the first week of June is absolutely packed with market-moving catalysts. We kick off Monday with the U.S. ISM Manufacturing PMI. A reading below 50 signals a slowdown, while above 50 supports the dollar. We also get India auto sales, which is a key consumer demand metric. Midweek on Wednesday, the U.S. services data drops, and remember, that represents 80% of the U.S. GDP. Concurrently, the RBI's Monetary Policy Committee begins its crucial 3-day meeting. And then Friday is the blockbuster day, culminating with the U.S. jobs report and India's provisional GDP data. Every single one of these data points is going to dictate capital flow.
And all of this data feeds directly into the most critical question as we head into the RBI's policy announcement next Friday. With a below-normal monsoon threatening agricultural output and domestic growth, but elevated crude oil prices and a weak rupee driving up imported inflation, what will the central bank do? Will the RBI prioritize growth, or will they hold the line against sticky inflation? The whole market is waiting for the answer. Keep this question in mind as the data rolls in next week. Thank you so much for joining this explainer, and we will see you next time to break it all down.